Something is deeply wrong with the British economy, and most people don't feel it yet, but they're about to. For decades, Britain quietly grew richer. Wages rose, living standards improved, public services expanded. Now that engine is stalling, and the warning lights are flashing red. If you're serious about understanding what's really happening and what must change, watch this video until the very end. The final insight may completely change how you see Britain's future. A long-term decline hidden in plain sight. If you zoom out and look at the UK economy since the 1950s, a troubling pattern emerges. Back then, GDP per capita grew at roughly 3% a year. That steady growth created prosperity, opportunity, and confidence. Today, that figure has collapsed to less than 1%. At the same time, the tax burden has surged. Taxes as a share of GDP have climbed from 29% to nearly 38%, approaching historic highs. So Britons are paying more, yet the economy is delivering less. That combination is toxic. This isn't just a bad year or a temporary slowdown. It's a structural shift. Productivity, the single most important driver of long-term prosperity, has flatlined. Productivity, the engine that stopped running. For decades, Britain's productivity grew by around 2% a year. That was the magic formula. Higher productivity meant higher wages, better living standards, and more funding for schools, hospitals, and infrastructure, without painful tax hikes. Then came the financial crisis, and productivity never truly recovered. If Britain had simply stayed on its post-war trend, the economy today would be dramatically larger. Instead, a recent flash estimate showed productivity falling by 0.8% in a single month. That's not a wobble, that's a warning siren. Now, economists are openly speculating that the Office for Budget Responsibility may downgrade future productivity forecasts in the upcoming budget. And that matters far more than it sounds. The 26 to 44 billion pound problem nobody wants to talk about. Here's where things get serious. A 0.3 percentage point downgrade in productivity growth creates a 26 billion pound hole in the government's finances. A 0.5 point downgrade? That's 44 billion pounds gone. To put that into perspective, George Osborne's infamous austerity budget in 2010 involved a contraction of around 40 billion pounds. We're talking about austerity scale numbers, without calling it austerity. And productivity isn't the only problem. Economic growth over the last 3 months has drifted dangerously close to zero. The labor market is softening, unemployment is ticking up. Payroll data shows fewer people in work. Recent tax rises, including higher national insurance, are increasing business costs and discouraging hiring. Britain now stands out internationally. Inflation above the OECD average and a weakening labor market at the same time. For a chancellor already facing low political capital and record high taxes, this is an unwelcome nightmare. Are the optimists right or just hopeful? Some economists argue the bad news is already priced in. The Office for National Statistics expected a weak start to the year. The numbers, grim as they look, were broadly in line with forecasts. Even the Bank of England, usually more pessimistic than the OBR, slightly upgraded its outlook, saying productivity growth may be somewhat less weak. And yes, if you're feeling generous, you could blame recent years on extraordinary shocks. Austerity, Brexit, COVID, the energy crisis. Remove those shocks, add a bit more investment, reduce labor market inactivity, and maybe productivity improves. Maybe AI boosts efficiency, maybe firms adapt. Maybe. But until the data proves it, this remains hope, not evidence. If the OBR aligns its forecast with the wider economic consensus, it would wipe out 20 billion pounds of fiscal headroom overnight. That almost certainly means future tax rises and weaker growth as a result. Borrowing isn't the escape route. Anymore, predicting productivity over 5 years is incredibly difficult. It's a judgment call, but one with massive consequences. And it's made harder by another problem. Borrowing is no longer cheap. Inflation has proven stubborn. Bond yields are rising globally. This year alone is a record year for gilt sales. Long-term fiscal forecasts look grim. And unlike the last decade, the Bank of England is no longer buying government debt. it's selling it. Growth in the first half of 2025 came in at 1.1%, which sounds respectable. But looming tax rises, a fragile global trade environment, and slowing real wage growth suggest demand could weaken sharply in the second half of the year. The old playbook no longer works. Can Britain escape the stagnation trap? There is a way out, but it's narrow. The real prize is productivity growth. Fix that, and everything becomes easier. The government hopes planning reform can help. Build more homes, lower housing costs, unlock construction, boost growth. In theory, it's powerful. In reality, planning reforms have been watered down. Construction is struggling. High building costs, weak demand, stamp duty, and regulation are all dragging the housing market down. Then there's industrial policy, announced just as industrial production became the biggest drag on growth. Manufacturing has shrunk from 16% of GDP in 1990 to just 8% today. Deindustrialization continues. High electricity prices are a major factor. Yet meaningful reforms, like regional pricing or cutting electricity taxes, remain off the table. Energy, inflation, and the pay dilemma energy prices are another unresolved crisis. Oil and gas prices have fallen sharply, but households and businesses haven't felt the benefit. Complex pricing systems and policy failures mean energy remains expensive, hurting competitiveness across the economy. Meanwhile, inflation has climbed back to 3.8%, eroding real wage gains. Workers are squeezed again. Spending slows. Investment suffers. Some bank executives argue public sector pay must be restrained to control inflation. Easy to say when your own salary runs into 8 figures. Public sector workers, after a decade of falling behind, aren't buying it. Strikes continue. Pay restraint is politically and socially explosive, yet inflation won't solve itself. The quiet signals of hope. And the choice ahead. There is some good news. Economic inactivity is slowly falling. More people are returning to work, easing pressure on the labor market and public finances. Consumers are also saving more, meaning future tax rises may not hit as hard as feared. But none of this fixes the core issue. Britain faces a choice: continue managing decline with higher taxes and lower growth, or confront the productivity crisis head-on with bold evidence-based reform. This moment will define the next decade. If you care about Britain's future, if you want honest analysis, not political spin, subscribe, share this video, and stay engaged. Real change starts with understanding the truth.